We we started it in my head not that long ago. We started it in probably November 2020. And our first big move was actually joining the Cultivator Start Cohort 4. So that was in February. So our ball has been really rolling at a high speed since February. But yeah, no, it's lots of fun.
That's awesome. Very cool. Good to meet you, Carmen.
Nice to meet you too, Jeff.
Yeah, I lost my unmute button. Okay, we got people rolling in now. I asked everybody if you're able to throw your camera on. We want this to be super interactive. Jeff has prepared an awesome session today. I'll give everybody like 30 more seconds to pop in, and then we'll start kicking things off.
Great.
Perfect. We have people joining from all around the province. We got some people in the Cultivator Global HQ, which is super exciting. So we had our friends from Collabs up in Saskatoon come down. Perfect. Keytown, you got off of the combine today? Or Catlin, why did I say Keytown? Catlin, you got off the combine today?
That's Dustin. He's stuck in the combine.
Oh, it's Dustin stuck in the combine. Okay.
Yeah.
You're the construction guy. I always get it confused.
Yeah, I'm not in the truck, so that's what you're thinking of.
There we go. Okay. Well, we'll get it kicked off here and then let people roll in. So I'm just going to stop sharing my screen so that Jeff can get his stuff rolling. But thank you, everybody. I'm Amy, if we haven't had the pleasure of meeting yet, part of Team Cultivator. And as Jordan wants us to say, we're the team behind the dream at Startup Summit. So the workshop portion of this event is really just designed for founders and team members to gain access to subject matter experts and leave with those tactical takeaways that you're able to make actionable on Monday. So every year we really look to find key areas of focus for these early stage tech companies. And something that we constantly hear is that equity is just something that's a little bit gray and teams would love to dive more in. So hence why we got our pal Jeff here. So he works in business development and partnerships at Carta. He is in Utah, so he's joining us remote right now. And so Jeff is leading a software company that helps companies, investors, and employees manage their equity. So he currently serves on the advisory boards for several startup companies and is an active angel investor. He's also an experienced entrepreneur himself and was founder and a CEO of a successful consumer goods company that was ranked 138th on the Inc. 500 list of fastest growing companies. He's very passionate about startups and enjoys working with founders and mentoring entrepreneurs. So with that, I think I'll just toss it over to our subject matter expert, Jeff. And Jeff does want it to be interactive session, so please drop questions in the chat throughout, and I will just let him take it away.
Amy, thank you so much, and thanks for that awesome intro. So no, I'm super excited to be here. Amy already kind of gave me the intro there, but like she said, I'm super passionate about working with startups. That's what I do kind of every day. And I'm also involved with, Carta, with equity. If you're not familiar with Carta, I'll tell you a little bit about it, but we deal with, tracking and issuing equity for startup companies. So that's what we're going to talk about today. Like Amy said, let's make this as interactive as you guys want. If you guys have questions as we go through, feel free to, in fact, if you want to throw them in the chat, maybe Amy, you could kind of monitor that, and because I can't see the chat window in presentation mode, but flag me for any questions and we'll dive in deeper as we need to. So with that, we're going to talk a little bit about Equity 101, kind of the basics of equity. And just to kind of set things from the very beginning, when we're talking about equity in your company, we're talking about the ownership. There are two types of ownership that you want to be aware of. We're going to focus specifically on the economic ownership today. I'm talking about when an investor, for example, gives you capital and you give them a percentage of the economic ownership in the company, or as you split up the economic ownership in terms of founders. That's what we're going to focus on. There's also something called governance that you need to also be aware of. So as you start to bring on board members and who makes decisions within the company and voting and all of that type of stuff, that can also, that is a component of ownership as well in terms of the company. But as we talk about economic ownership, this is what gets divided up at the end of the company if you sell or exit in those percentages. So that's what we're going to focus on. And as we dive into this, we're going to be talking specifically about corporations. So I don't know how many of you are set up as a corporation versus a limited liability company or some other structure. We'll focus on corporations, but all of these principles apply regardless of whether you're an LLC or what type of company you're set up as. So as you start your company, you guys have probably already, issued some equity to the founding group, and you would typically have common shares, or as an LLC, common units. And as you bring on employees or things like that, they would also have what are called common shares. And these are kind of on the bottom of the totem pole in terms of they're the last individuals to get paid out upon liquidation of the company. And so that's why you have different classes of shares. And so you have your preferred shares that you would start to issue when you start to bring on investment. So investors would receive preferred shares. And the difference here is that the preferred shares have something called a preference, which means that they get priority in getting their investment back first upon a liquidation of the company. And then they can convert those preferred shares into common shares if it makes sense for them to participate in the upside just with the company and not just get their money back. One of the things you'll come across is a liquidation preference that would be in your preferred shares. And right now in this environment, anything different than a 1x liquidation preference, meaning that the investor would just get their money back if they didn't convert to common shares, is probably worth taking a second look at. Sometimes investors will say, we want our money back plus a 2x return, for example. So you'd have a 2x or a 2 times liquidation preference where the investor would say, before anyone else gets paid back, we want our investment back plus a return of 2x. So those are things that you'll deal with as you come across investors. Right now, like I said, if there's anything different than a 1x liquidation preference in your preferred shares, then you probably should get a different term sheet or look at different investors. Anyways, I'll pause there and see if there's any questions that you guys have, or if you have any of you raised capital at this point from investors. Not yet. Okay, so that's something that you'll want to be aware of. And as you get the term sheets, definitely look for any liquidation preferences that might be in term sheets. There's also something called participation rights that in this environment where investment is flowing pretty freely, you probably wouldn't see participation rights, which means that the investor would not only get their money back, but then after that, they would start participating with all the common shareholders. So that's very advantageous to the investors, but something you probably wouldn't expect to see in this environment of funding right now. So I hope that's helpful. We're going to move on to another type of instrument that you guys may come across, especially in the early stages, and these are convertibles. So your convertible notes, or you may have heard of SAFE agreements. A SAFE is a simple agreement for future equity, and these are becoming very popular, especially in Silicon Valley, but it's spreading throughout the entrepreneurial ecosystem globally. Both of these instruments, a convertible note and a SAFE, they have the option to convert their investment into shares at a later date. And so in the case of a convertible note, this is actually debt. So the investor might give you $100,000. They could, that would typically have in the form of a note, you would have a maturity date with that. So let's say a year from now, there might be a maturity date where they could say, we want our $100,000 back. And in a convertible note, there's typically interest involved as well. So let's say it's an 8% interest rate, you'd owe, the $100,000 plus the 8% interest at the end of the term. That interest will accrue. And so even when it does convert to equity, then the investor gets a little bit more equity. Honestly, from an investor standpoint, they are not concerned about the interest rate. If they have to get their money back and they call the note and they are relying on interest as a return, this has not been a very good investment for them. So keep that in mind. The interest rate should be, pretty kind of just kind of something in there. If it's 6 to 8% is pretty standard. Convertible notes are typically a little bit more investor friendly. One thing that I will say there is that one thing to know as a founder is that technically the convertible note holder could call the note at the end of the maturity date and force you to repay it. And if that happens, you're probably not in a great spot, because the reason they're probably calling is because they see that there's not the value that they thought there might be in the company. And in all likelihood, you probably don't have the cash to pay them back at this point because you haven't been successful at raising your next round. And so worst case scenario is the investor could call it, and if you can't come up with their investment back, they could take over the company and take your IP and any of the assets in the company. And so that's kind of a worst case scenario. It doesn't happen very often, but it's something that you should be cognizant of. What will typically happen is you would renegotiate terms and they might extend it, and as you are trying to raise that next round of funding. Your SAFE agreements don't typically have the interest rate or a maturity date associated with them. It's actually not debt. It is just an agreement that at your next funding round, they will convert this into equity. And so two things that you're going to have with your convertibles is something called a valuation cap and also a discount. You might have one or the other. The discount, so for example, let's walk through a SAFE. If the SAFE has a 20% discount, that means that upon your next fundraise, the SAFE investor would be able to convert their investment into shares of your company at a discount of 20%. So they would, instead of paying $1 per share, like the Series A investors, they would pay 80 cents a share. So that is the discount. There's also most angel investors or early stage investors might also put a cap on the investment. And what that means is that they're saying, let's put a valuation, and if the valuation is over a certain amount, then we get to convert at this amount or this valuation that we agree upon right now. The benefit of doing a convertible has traditionally been that it's a lot simpler and easier, especially a SAFE. You can get a SAFE document, send it to an investor, they sign off on it, and you talk about what is the discount and if there's a valuation cap, and you're done. So super easy. You could just go right into a price round, and if you're going to be negotiating a valuation cap, you just use that valuation. Why you don't see that typically happen in the earliest stages, because it can be kind of expensive. So if you're only raising a couple $100,000, for example, your attorney fees might be disproportionately large. So it's pretty easy to just do a SAFE agreement, and then when you raise a larger round, to memorialize that in terms of the valuation of the company. So again, I'm going to pause there and see if there are any questions on convertibles, SAFEs, convertible notes, all that stuff. We covered
Anybody
a lot.
here raised on a convertible, or are you thinking about it? No, nobody.
It's very common. So I mean, a lot of times your first round would be through a convertible. as you start to talk to angels or friends and family, just a simple way to get that first money in. So I
Maybe
hope
Jeff, speak to, I know that there's, like, we've just heard, being in Saskatchewan here, just a few horror stories on raising on convertible notes. Do you see, like, what are some of, like, I guess, benefits and downfalls that you see with that?
yeah, again, the biggest benefit is that it's simple and pretty straightforward and easy. Again, the biggest downfall might be that in a convertible note scenario, you could get your investment called because there is a maturity date. For the safes, they have become very popular and they are much more founder friendly because there's not a maturity date. And the investor's taking quite a bit of risk saying that we're counting on you raising another round so that we can actually convert this. And if you go for 2 years and don't convert, and you start to build value in the company and you haven't priced around, all of a sudden, if the investor doesn't have a valuation cap on the safe, then they could put in $100,000 and all of a sudden the company's worth 10 million and they didn't put a valuation cap in and they get diluted. And so there's a lot more risk on the investor side. And so that's why you will typically see a valuation cap, especially if there's any concern that you're not going to be able to raise a round in the next 6 to 12 months. So again, I hope that's helpful. Something else that we'll kind of move on to here that you will most likely run into is as you're starting to attract talent and hire new employees, or if you have advisors, you may start to issue out stock options. So, or incentive options in your company. And what a stock option is it's not actually shares of the company, but it's the option to purchase shares in your company at a later date. And so when you give an employee or an advisor stock options, they don't have the obligation to buy these shares, but they have the option to buy them. And the hope is from the employee or advisor standpoint is that you'll issue these shares with a low, what's called strike price. And, let's say it's 5 cents a share. And then 3 years later, the company's worth $10 a share. They can buy the shares now, or they have the option to buy them at 3 cents, and they're actually worth $10. So that's a pretty good return, right? So that's the incentive there. And there's something called incentive stock options, which are specifically for employees. And the reason that you have incentive stock options, I'm talking about the US, so I don't know how many of you are incorporated in the US or if you have US-based employees, but there's something called ISOs for US-based employees where they have tax benefits. And then if you're not an employee, you would receive what's called non-qualified stock options, which don't have these tax benefits. So I'm going to just pause and ask a quick question. Is there anyone here that's like a Delaware C Corp or a corporation based or incorporated in the US, or is everybody a Canadian corporation in the cohort?
Feel free to hit an unmute. Nobody, everybody's.
Is everybody a Canadian corporation?
I am, yes.
Okay, sounds like. So you're not have to worry unless you have US-based employees, even remotely, you might run into some of the IRS regulations with stock options. But the key point is you do need to keep track of them. If you do start to issue different types of options, you'll need to keep track of them. Also, if you are dealing with employees in the US, there's something called a 409A valuation, which helps set the strike price. I know with Canadian corporations, you can also get a 409A valuation, but it's something that helps you set the strike price of your stock options. You can also have the board determine your stock options, but it's good to have a good startup attorney that can guide you here in terms of how to value your stock options. So another component of stock options or incentive equity It also applies to your founder shares. So, and that's vesting. And a lot of times founders frown upon vesting and they think, well, this is my company, I shouldn't have to vest my shares, right? However, there's a protection, especially if you have multiple founders in your company. You want to put a vesting schedule in place. And the reason for this is, as a founding team, let's say you've got three founders, and 6 months into this, one of the founders gets offered a job opportunity that they just can't turn down. And you've split up the equity, you've each got 33% of the company, and then that founder leaves. And he says, good luck to the other two of you. I hope you make my investment, really profitable, appreciate it, but I've got to go take this other opportunity. Well, the other two founders, you're thinking, well, that's not really fair that he takes off after, or she takes off after, 6 months. And so that's why you would want to put a vesting schedule in place, that where you earn your shares in the company over a period of time. For founders, this can be, probably at least 4 years in terms of vesting. A lot of times founders will even want longer vesting periods because, you're in it for the long haul, and the typical startup, it takes like 10 years to get to an exit. And so investors will also want to make sure that you've got a vesting schedule. So if you haven't already put a vesting schedule in place and you're going out to raise capital, your investors are going to put a vesting schedule in place for your founder shares as part of the financing round, because they want to make sure you stick around and that you have an incentive to be with the company and grow it. So that's from the founder's perspective. Same thing from an employee's perspective. As you bring on a new employee, the last thing you want to have happen is you give them a percentage of the company in equity, and then 6 months into it, they leave. And if you've just given them straight equity, they take that with them. And that's why, again, you put in a vesting schedule. What's very common for employees is to put in a vesting schedule that would be like a 4-year vesting period that might vest each month over that 4 years. So there's 48, every month they would receive 1/48 of shares. But then there's something called a cliff period. So again, it's very common to have like a 1-year cliff, where if that employee were to leave within the first year, then their stock options would accrue, but they wouldn't actually receive any until after their 1-year anniversary. So if they left in that first year, they wouldn't receive any of their stock options. So again, that's something very common, where you as a founder and a founding team are going to invest in a new employee. And if they don't stick around for at least a year, then it might be fair to say, okay, we're not going to give you equity in the company. Once they hit their 1-year anniversary in that scenario, where they've got, a 4-year vesting period, they would then receive 25% of their shares or their options at that point. So hopefully that makes sense in terms of stock options, how that works, and the vesting. Again, any questions on vesting or share allocations like that? Oh, I think you went on mute. Is that Nelson?
Hello?
Oh, there you are.
I think the problem, they might be in the same room. I think Rachel, maybe if you're hooked up to the TV, maybe you have to unmute. The old Zoom audio feedback.
And Nelson, feel free to type in your question as well, and Amy can read that as well, if that's helpful.
You might be able to unmute, but we will watch the chat. Oh,
You guys
there we go. Yeah, you're good now. No.
There we
feedback.
go.
So a question that I think I'm just wondering about is, if you do employ a vesting schedule with a cliff period on the premise, like early on into the business, that like these are the shares that will be allocated, and then you decide, say 6-8 months through to reallocate shares How does that generally work out with like a founding team, common shares, and kind of pre-priced round?
Yeah, great question. So let's take the example of a founder, and let's say that the founding team, you've got 3 members, and you've allocated the equity up front, and you each own a third. And then you're 9 months into the venture. One of the founders is doing most of the work, and everybody agrees that you should give her more equity. You would then just issue additional equity, and you can put a vesting schedule to that. But you might grant her more equity, and the other 2 founders would then be diluted in terms of their ownership percentage. Again, that's something that as a founding team, I think is very important to have those open and honest conversations and keep those lines of communication open. But I will say it's very important to try to map that out from the very beginning. I've seen horror stories where a founding team says, oh yeah, we're all going to contribute the same amount and we'll just divide things up, 1/3 each. And then you get into it and 2 of the founders feel like they're pulling all the weight, and it causes all kinds of problems. And so, then you have to have some tough discussions of, okay, you haven't followed through on what we agreed to up front. So again, I think having those discussions up front as a founding team and setting expectations from the very beginning is very critical. And I would document those things as well, so you can always have something to go back to. Is that helpful, Nelson? Awesome. Great question.
Jeff, I'll ask a question as well if I can.
Yes.
We've been discussing here on, we'll say, your point about, say, unvested options, and at the time that an employee ceases to work for the startup, that those would obviously naturally fall away. But I'm curious what you might have been seeing when it comes to once the employee has vested and perhaps even exercised, and then is actually a common shareholder in the company, whether the company is still insisting on some rights of repurchase or perhaps voting powers of attorney over their shares in the company to sort of constrain, because they've obviously earned them. They've worked through the vesting period, but if they depart and we still want the ability perhaps to clean up the cap table once they've exited, are you seeing things like that? I've certainly seen differences in those situations that might distinguish the treatment between a with cause or without cause termination. So just curious on, we'll call it once they've actually vested and perhaps exercised, what you might have seen.
Yeah, that's an excellent question. The first thing I'll mention is I'm not an attorney, and so none of this is legal advice. I'll just set that clear.
Funny thing is, Joe that just spoke is a lawyer.
Okay, well, good.
Yeah.
Okay, then I would say consult your attorney on something like that. But I'll tell you just what we've seen, or what I've seen personally, is when it comes to when you're dealing with stock options, the employee would have the opportunity to exercise their shares. So if they've exercised their shares and they purchase those, and they're now a common shareholder, it's probably pretty typical for them to remain a common shareholder. You can do some different things like restricted stock awards, where they have different rules, where the only time that an employee would be able to exercise those is upon a liquidation event or a certain event within the company. And so if they left, then they might not have the ability to exercise. So there's all kinds of things you can do. I will say, just from a personal opinion, I feel like if an employee's been there for a few years, they've earned their equity, and they can exercise their shares, and they've contributed, it seems fair that they would be a shareholder. I have seen employees depart where they had, RSAs or RSUs, where, they may have earned equity in the company over the last 5 years, and then the company still hasn't gone public or anything, and then they leave, and then they give up all their equity. So from the company's perspective, there's definitely some incentive to keep the employee around, but you're kind of tying them to the company. So the downside of that is that you might get employees that stick around that really don't want to be there anymore. And is that really the best scenario? So there are all kinds of things like that you have to consider. But I have seen disgruntled employees say that, when they left the company, they gave up all their equity. A year later, the company sells and they miss out on all the equity. You can kind of look at that as that was good for the company, not good for the employee. Again, that becomes down to kind of your philosophy as a founder and kind of how you want to structure things. So is that helpful?
No, I think that is, Jeff, and I tend to echo the same comment that, from a preference standpoint, I think more founders that I've certainly dealt with take the viewpoint that, once the person's been there, contributed substantial sweat equity towards the company, moved the needle on things, that it's not fair to, quote, pull the rug out from underneath them, say repurchasing if they decide to move on. And frankly, some of this might trench into other parts of your conversation at the beginning on governance, where even if they own a small minority interest in the company, you're still having them enter into shareholder agreements or voting agreements, et cetera, which would otherwise constrain any, ability for bad behavior they might have if you're, say, looking at a liquidation event or something like that. So
yeah, great thoughts. Yep. So man, you're an awesome resource here for this group. You can tell you've dealt with all of this previously. So great comments. Okay, so we'll move on from vesting here and we'll get into equity management. Because I mean, as you guys start out your companies, you start issuing founder shares, and then you may have investors that come in, you're issuing preferred shares, and then you may get a convertible note that comes in. You need to keep track of what the terms are, if it's a safe agreement. And then, you might start issuing stock options. And you have to keep track of, if they are ISOs or different types of stock options, keeping track of that, keeping track of vesting schedules with, your founder shares, with your stock options. And then, you might, as the company grows, you may have additional investors that come in and you're issuing additional equity, maybe more stock options as you're growing, more vesting schedules to figure out. And you can see pretty quickly it can get kind of messy. And so the question for you guys as founders is, how do you keep track of all of this? And that's where you get into the cap table. So right now, I'm guessing that most of your cap tables are pretty simple. If you've just got a couple of founders and you've allocated some shares to each founder, you can keep track of that in a spreadsheet, and it's really simple and easy. But you can imagine that as you start to get investors with different types of shares or different classes of shares you start to issue, and then bring on employees, and they have vesting schedules to keep track of. And then you've got convertible notes to keep track of and when they're going to, convert. And keeping track of all this can get pretty cumbersome pretty quickly. And so it is important for you to keep track of anything that you do in the company that might impact your equity. So your cap table is going to be a tool that you use to help keep track of how much equity you own. Your equity percentage in your company is going to change over time as you bring in new investors and issue out additional shares to them or to new employees or to advisors. Your equity will change with each of those, or your equity percentage. And so again, keeping track of that at any given point in time is super important. You want to keep track of how much money's been invested, in your company over time. Who owns what types of shares? As you start to think about hiring employees, you'll typically carve out an option pool where you'll issue employee, options out of that pool. And you want to make sure you keep track of that, so you're not issuing more options than you actually have to issue in your pool that have been allocated. So again, all of these things are kept track of in your cap table. And ideally, you want to keep your cap table up to date. So anytime anything changes, you just go in and you change your cap table, you update it, and it changes all of the percentages for everybody. And so then at any point in time, you can go in and say, okay, this is where our equity ownership looks like as of today. In reality, that doesn't happen. And what will typically happen is, and again, this is something I'll caution you to not let happen, but a lot of times you as a founder, you're interested in running your business. You've got a lot more important things at the time, it seems, than to go update your cap table because you promised equity to somebody. And plus, a lot of times founders think, well, then I'm going to have to call my attorney and tell them they're going to charge me for updating my cap table. I don't want to incur any lawyer fees. And so we'll just do this later. And you put it off, and then you promise equity to somebody else, yeah, we'll take care of that. And then you forget about it. And then your cap table doesn't get updated. And then you go to raise a round of funding, and the first thing your investors ask you for is to see your cap table. And then you're scrambling going, oh man, that's right. Who did we promise equity to? And oh, I know we forgot something. So that is a typical scenario, and why we see it at Carta, it's something like 80% of all cap tables are wrong. And so it's very important to keep this up to date, because what will happen in those scenarios more often than not is that as you're preparing for your fundraise, you now go to your attorney and they say, well, give me all of your documentation so that we can now reconcile your cap table. And then once they reconcile your cap table, they give you a large legal bill, and you haven't raised any capital yet. And so they defer it. And so then part of that capital you eventually raise ends up going to your attorneys, who had to reconcile all of this stuff that you could have easily been keeping track of. So again, that's something to avoid as founders by simply updating your cap table as you go along. And so I've listed a few things of why your cap table is important here. One of the things that I've heard a lot of attorneys say is that they're constantly reminding founders that they only have 100% of the company to give away. And that might seem like that totally makes sense, but if you're not keeping track of it, and you have authorized 10 million shares, and you've given away now 12 million shares, that's a problem. And then as you as a founder, as you start giving away more and more shares and you're not keeping track of it, pretty soon you can be diluted to the point where an investor would look at that and say, you don't own enough of this company to even make it make sense for you to keep doing this. And so again, keeping track of the equity is super important in that regard. Also, just your cap table is going to keep track of all of the changes over time, so you can go back and kind of look at changes. You'll also use your cap table as a tool for when you are raising money to project things out and figure out how much dilution you might incur when you do raise your money. And so your cap table becomes a tool that you can run scenario analysis or scenario models and say, okay, if we raise $5 million at this valuation, what's that going to do to my shares and to our existing founder group and our existing employees? So again, your cap table becomes a very important tool for that. It's also going to be the tool that helps you to track employee options and investing schedules. It helps decrease the time and effort of investors as they go through the due diligence process. You don't want your investors being the ones to build out your cap table for you. You want to be able to hand them a nice clean cap table. It builds confidence in your investors. And we can talk about that here in a second. But the other thing I'll mention is it also will help you, if you keep your cap table up to date, to avoid lawsuits. You may have read horror stories in the news where a company has a liquidation event, they sell for millions or billions of dollars, and an investor comes later and says, hey, I owned 3% of this company. Here, I've got it on this napkin that that we agreed to. And all of a sudden now all of your past investors, they just made decisions based on a cap table that didn't include material information. And so now you've got lawsuits and all kinds of fun stuff. So avoid that at all costs. Keep your cap table up to date. It can be simple and easy to do if you stay on top of it. So definitely do that. Before we jump into this, I'll pause and see if there are any questions, but we're going to talk a little bit about, why you would want to keep some other additional reasons you'll want to keep your cap table up to date. But would love to hear any questions you guys might have on cap tables or managing your equity. Again, if you have any questions, feel free to put them in the chat and Amy can kind of monitor that as well.
Yeah, for sure. So Joe just put a good article in the chat there too, but feel free guys to unmute or throw it in the chat or else ponder it and we can revisit questions at the end as well.
Awesome. Okay, so we'll go over this, and this is something that you as founders.
We got one question here, Jeff. Sorry, just from Nelson, and is it common to have an option pool pre-priced round?
Yeah, excellent question. As we get into carving out the option pool, that's something that your investors will probably require. So if you've already, and they're going to tell you what it should be based on what they think. But if you as a founder have already thought it through, and if you can tie that back to your hiring needs and say, okay, we're raising, $1 million and it's going to go to these things, and we're going to hire these 3 people in engineering, these 2 people, and this other person, and this is the equity that we're going to give, allocate to each of them. You can then build in the option pool and say, this is how many options or shares we're going to need for the next 12 to 18 months once you give us that $1 million. And it ends up being 8% of the pool, an 8% option pool. Well, the investors, if you don't have that, they'll probably just say, well, we think it should be 15%. And the dilution is not going to come from the investors. It's going to come from you as a founder. And, granted, you might not use that 15%, and maybe that does come back to you, or you use it for the future and it rolls over. But, as a founder, I would be the one that would drive that decision and be able to tell my investors, this is what the option pool should be because these are our hiring needs over the next, 18 months. That's going to make you look better as a founder, like you know what you're doing, but it's also going to give you a position to negotiate what the option pool should be and what's the investor going to say. If you've already thought it through, they might say, well, we think you might need a few additional, employees, so let's, put some more cushion in there, but you have a good stance to negotiate from. So does that make sense?
Yeah. He's also just wondering too, I know you kind of noted on it just based on some different stuff, but wondering about how large, maybe from your experience, you've seen these.
Again, that's going to depend on your hiring needs and the growth phase that you're in as well. If you're going to be hiring a ton of new employees with this new capital, it might be a higher percentage if you're in that super, mega growth stage. But just in terms of ballpark, you're typically seeing, an 8 to 20% option pool. Somewhere in the middle there would probably be most common. But again, I wouldn't just, pick a random number. I would try and consciously determine how many shares you're going to give to employees and figure out your hiring plans over the next, 18 months or so. Okay. One other thing I'll mention is that when it comes to how much equity to give to employees or to advisors and things like that, Carta actually has some benchmark data that we could even share with Cultivator as reference points so you can kind of see at different stages of your company how much, you know, a VP of sales might get in terms of equity, how much a CTO, you know, if they're based in Saskatchewan, how much equity would you give them typically, at least to have some numbers to look at. So Amy, if you want to follow up with me afterwards, I can get you some of that information to share.
Yeah, that would be awesome. We for sure will share that out with the group.
All right. So a lot of times when you as a founder are giving your cap table to your investors, you're thinking that, you know, okay, that's not a big deal. They'll look at my cap table, see how much equity I own, and that's it. But I'll just let you know that investors look at your cap table, and there's a lot more they can tell about you and your company by looking at the cap table. So here's some of the things that they're going to look for. First, they'll look for errors. If they see that you don't know how to manage a cap table, that could throw up a little bit of a red flag and might suggest that you need somebody on your team that knows how to manage things, or you need a better attorney or some support in that regard. If they see errors, that's going to throw up red flags, and it might, cause some concern over, are these guys going to take care of my equity and make sure they're good stewards of the equity that they're granting me. The other thing they'll look for is, do you as founders and do your key employees have enough equity to get you through the funding rounds in the future and still have enough incentive to stick around? And so that's going to be a big deal. So they'll look for that. They'll look for who else is on the cap table. If they see an unreputable investor that they don't want to be associated with on the cap table, that again can cause a red flag. And so the point there is, be careful of who you let on your cap table. They'll look for liquidation preferences, or we talked a little bit about participation rights. If there are weird terms in your previous rounds, that will come up and show up on the cap table, and they're going to want to know about them. And at the very least, they'll probably want to dig into it deeper and maybe require those same terms or better than what the previous investors got. So that shows up on your cap table. Again, they'll look for things like, is it organized? Does it add up and make sense? So those are some things that investors will look for. I've got this next slide, which is, it kind of covers most of this, but it brings up a couple other things that investors are going to zero in on as well. We talked about your option pool. They'll zero in on, how much do you have in your option pool? Do you have enough left for the next, this next period of time? And can you back that up with your data? They're also going to look at, historically, who has left your company. They're going to be able to see, from your cap table, if employees have left the company, and it might, if you've got a lot of employees that have left, they might dig into things like, are there culture issues? Why are so many people leaving? And then they'll even look a little deeper and might say, these employees, they had vested over 3 years and none of them exercised their options. Do these employees know something that we should know as investors? And maybe they'll start interviewing them. So there's things like that you want to be cognizant of as a founder, that investors will drill into as they look at your cap table. They'll also look for who else is on the cap table, like we talked about. If they see that, Johnny has 30% stake in the company and they don't know who Johnny is, and he's, one of the founder's uncles, they're going to dig into that and say, who's Johnny? What's he contributing? Why does he own, this percentage of the company? So be cognizant of all that stuff as you're setting your companies up, as you're letting investors on, as you're granting equity to other individuals. All of this becomes fairly transparent when it comes to raising capital with your investors. So again, I'll pause there. Amy, any questions coming in on the chat?
Let me look here. Nothing on the chat right now, but if anybody wants to unmute.
Okay, and I wanted to leave a couple minutes for Q&A here. So I'm going to just fly through some of these best practices. The first thing I would counsel any startup I work with is make sure you have an experienced law firm or attorney that deals with startups specifically. A good startup attorney is somebody that has been through a Series A, Series B, Series C. They know how to, how to set up a startup company, what entities you do this, and they do this every day. They deal specifically with startups. Don't go to a corporate attorney who's been at, Procter & Gamble for 30 years. They probably don't know anything about startup law. And if they do, then it may be outdated. Go to a startup attorney who's involved every day in running startups. I would do things right from the beginning, set things up correctly from the beginning. And again, a good startup attorney will help you to do that. There are all kinds of considerations to take into account when you're setting up your company. And again, an experienced startup attorney will help guide you through that. It's worth the investment. Also, keep things simple and standard. The last thing an investor wants to see is some weird agreement that an angel investor came in that is used to investing in real estate, and they apply all these weird terms to your startup company. And they look at this agreement and they're like, that is just bizarre. We don't even get it. That can kill deals. It can cause all kinds of issues when you go to raise capital. A good startup attorney, again, will help you keep things simple. They know what standards are. They will guide you through that process. And then lastly, do things on software. If your attorney is insisting that you issue paper stock certificates still, they're probably not that experienced. I would definitely encourage people to use software. It helps to keep things up to date. It makes things easier for you, for your law firm, for your investors. There's software programs. That's actually what Carta does, is provide software to keep track of your equity and help issue everything digitally through that. So I'll leave it at that. I'll just briefly talk a little bit about Carta. It's a software management platform that helps you keep your cap table up to date. Again, it issues all of the equity electronically, so your investors can digitally sign it, keeps a full audit trail. It makes it so that when you do issue equity, it automatically updates your cap table for you. And then it provides tools to help you to be able to use your cap table to model things out and say, okay, under this scenario, if we raise this much money, under these terms, what would this do to our cap table? And it makes it so it's a lot easier to manage and do scenario modeling with your cap table. Okay, and then I will just end with a couple of resources that are available for you guys. I mentioned the total compensation. Amy, I'll get that information over to you in terms of benchmark data as you guys start to figure out how much equity to grant to employees or advisors. Carta also has a free founder resource center. If you just go to carta.com, or if you Google Carta Founder Resource Center, amazing resources, especially as you're starting to look at raising capital. There's all kinds of video tutorials. There's free safe and convertible note calculators, a ton of content that will help you as founders as you run into questions along the way. I'll also mention that there's something called the Startup Stack. If you go to mystartupstack.com, it has all kinds of software offerings that you can take advantage of early stage founders. A lot of companies will allow you to use their tools for free as an early stage company. Take advantage of things like that. It can be really helpful for you guys and help increase the likelihood of success as you're using these different tools that are available. And again, like I said, a lot of these companies will allow you to use their tools for free, hoping that you will find value in them. And then as you grow, you will continue to use their tools. In this regard, Carta is no exception. We have a free Carta plan for early stage startups. If you've raised less than $1 million, you can use the software to manage your cap table and issue equity for free. You can use all the modeling tools. And then through Cultivator, we've also got if you do need to upgrade to a paid plan eventually, you've raised more than $1 million and it's been something beneficial, you'll receive a 20% first year discount as well, as a part of Cultivator. So I will leave you with that. And like I said, I love working with startups. So if you guys do run into questions and things like that you think I could be helpful with, feel free to connect with me on LinkedIn, and always happy to answer simple questions. Again, I'm not going to give legal advice, but if there's something I can do to be helpful, always happy to do so. So with that, I will open it up for any final questions or that you guys might have, or things that you might want to dig into a little bit deeper. I think we've got like 5 minutes or so. Is that right?
Yeah, totally. So we'll use this final 5 minutes to throw any questions out there. Well, maybe the crew's thinking of one. What would you say if you had to pick one number one tip for the startups here on this call when they're looking to start raising equity? What's the biggest piece of advice you'd throw their way?
I think it was number one on my list, and that's to get a good startup attorney. It is worth its weight in gold. They will help you to do things accurate. You will save a lot of time, effort, heartache, and money by having a good startup attorney on your side that you can refer to. And they might be kind of expensive, but it's definitely worth it if you're in it for the long haul. So it will come back to you in spades.
Awesome. I bet Joe Gill's heart is beaming right now.
Joe, it sounds like Joe's got a competitive advantage here with some of his knowledge, so that's super helpful. That kind of goes to another point, and that's to get good mentors. Get people that have been through this before. Typically, somebody that's been an entrepreneur that's been through this before and been through an exit and been through that, they love working with startups, so they're typically willing to help you for free. And then if they become more involved, you can, and more valuable, you might bring them on as an advisor or something. But typically, you can get a lot of good mentorship for free.
Totally. Okay, we have a couple other things coming in the chat. So question from Matt is, do you have any strategies for getting founders who were in the room off the cap table when you're going after financing?
Oh, man. I think, again, the key is to have really good, open, honest communication. If there are reasons for getting a founder off the cap table, talk to them openly about, what the concerns are. If it becomes heated, that can become a real problem, especially as you're going in to raise capital. If you've got a disgruntled founder, that's going to come up. And those are tough things. And I think you have to handle it situation by situation. It kind of goes back to setting things up and setting expectations from the very beginning. And so you've got documentation that you can always go back to and point to and say, hey, look, this isn't working out. And maybe you do negotiate, you put some negotiation in there, realizing that if they stick around, they're going to hurt the chances of the company succeeding. Again, it kind of goes back to be very thoughtful at the very beginning when you're setting things up.
Totally. Yeah. Okay. Well, just in the interest of time, we'll probably close it out here. Yvonne is just wondering if you do have any resources on governance ownership. So maybe that's even something, if you do have them, you can shoot me an email and I can pass them off to Yvonne.
Absolutely. And then again, that's something to set up. for initially, like in all of your documentation. So again, I keep going back to get a good startup attorney, but they will help you to make sure the governance and all of that stuff is structured properly at the very beginning. They will look at it from the viewpoint of if things go wrong, then we've got provisions to protect the founders. You know, even in the case of if you've got a founder that you want to dismiss, a good startup attorney will help set that up so you've got a good premise to deal with that when it does come up later on.
Okay, well, this has been fantastic, Jeff. Thank you so much for taking the time. I think everybody here is able to definitely walk away with some tactical takeaways. Said it too many times this week. But yeah, this has been fantastic. And make sure, as Jeff said, connect them on LinkedIn. He had his email in there, a wealth of knowledge that is at your disposal now. So we really appreciate you coming to Sask Startup Summit, Jeff. And there will be a swag bag for you in the mail.
Oh man, are you serious? Okay.
Oh, we pride ourselves in good swag. Yeah, I'm rocking it right now. So it's coming your way.
Oh my gosh, you guys are awesome. This has been fantastic to be a part of. I hope it was helpful. And again, if there's anything I can do to be helpful, just let me know.
Awesome. Okay, well, thank you, everybody. This has been great, and enjoy the rest of your day. We'll see you soon.